right. Well, welcome everyone. Hope that was a great upbeat start to a lunch and learn webinar featuring a report on impact and financial performance of impact investing in Canada. So big welcome. My name is Adam Spence, CEO and Director of SVX, and really delighted that you're joining us here today for this particular session. And so we'll start things off in a good way, just with a land acknowledgement. And although we're meeting on a virtual platform, I want to acknowledge that the team primarily lives and works on the ancestral lands of the Anishinaabe, the Huron-Wendat, Haudenosaunee peoples, and the treaty lands and territory of the Mississaugas of the Credit. Toronto is in the Dish with One Spoon territory in the Toronto Treaty of 1805, also known as Treaty 13. Today, the region is still home to Indigenous people from across Turtle Island. We're grateful to have the opportunity to meet and work on this territory. For more information, you can visit, it's a really great website, amazing resource, contains demographic, geographic, historical, and treaty information at nativeland.ca. Also want to make sure from a disclaimer perspective, we're talking about financial information. This particular document and materials that we're sharing is not intended to be, it's not taken as an offering to sell or to solicit any financial securities. And so the information that we're containing and talking about today is just for informational purposes, as is information contained within the supplementary report. You can take a look at that. We'll share that resource in just a second. So what are we going to cover today? Bit of an agenda for this particular webinar, next 60 minutes or so. We'll talk a bit about the organization, the work that we're doing, provide some background on the report. There'll be an opportunity to do some key findings and a deep dive on what we went through. Then some recommendations and some next steps for both the sector as well as the report. And then we want to make sure there's plenty of time for questions and discussion. Really keen to get your questions, your feedback, and then we'll have an opportunity for a wrap up, again, to end within the 60-minute mark or so. On the housekeeping side of things, want to make sure if you have any questions, please put those in the chat. We're going to take questions once we're through about the 25-minute mark of the presentation. I'll kind of close things off the presentation, then provide opportunity for discussion. If you have needs for technical assistance support, then also put those in the chat. We can help you along the way. And if you want to introduce yourself, those that are comfortable, feel free to let folks know who you are, the organization that you work for, and even where you're living and working. And we'll make sure there's a good and robust discussion in the chat as well. So that gives you a bit of background and what we're going to cover today. So let's dive right in then, and providing ourselves with a bit of background first on SVX. For those that are not familiar with what we do as an organization, so our mission is to advance social, economic, and environmental justice through impact investing. We're a nonprofit, diversified financial services firm, and we work with investors, funds, enterprises, and institutions, including governments and financial institutions, to help them take the first or next step on their impact investing journey. You might ask the question, what is impact investing? Or how do I create a strategy? Or how do I manage and support my impact investing mandate? And we help folks walk along the journey and ask and answer those questions. We do that through a number of different ways: educational programs, knowledge products and solutions, often one-to-many initiatives. We have one-on-one advisory and support services, helping people design those strategies and products. We manage funds, particularly place-based and increasingly thematic funds. We have an impact investing platform, the Impact Index, and we advance and seek to develop with partners systems change solutions. How do you create the right conditions for policy and ecosystem infrastructure to allow impact investing to thrive? And we do that across a range of different sectors, from climate action and biodiversity, community real estate, equity, and beyond. And we're organized as an exempt market dealer in a number of different provinces across Canada. And then we also operate in the US, in Mexico, Colombia, and other parts of the Americas. Then what is the Impact Index? Just a bit of background on that. It's an anchor for what we're talking about today. Really, it's a database or repository of information representing the universe of products across Canada that are available to Canadian investors. There's over 200 products on an ongoing basis that are often available on the platform. And it features a range of debt and equity opportunities, from private equity funds to housing bonds, between 2 million and 100 million plus, some in many cases are even larger. Also allows folks to access the Impact Index Plus, which is a group of more qualified impact investing offerings that meet certain standards related to their governance, their impact, and their finances as well. And you can see more and learn more at impactindex.svx.ca. Then a bit of background on the partners and sponsors that helped to bring this together. We had a number of different collaborators that helped to make this happen. University of Victoria Impact Investing Hub, Rodman School of Management, University of Toronto, Tapestry Community Capital, Genesis Capital Management, High Street Asset Management as ecosystem partners for SVX, as well as a generous contribution from the Cambia Development Foundation. All these actors played a key and important role to be able to resource and complete the work that was required in order to put this report to market. Then other folks that were involved in this particular project want to recognize and acknowledge the authors. Sharujan from our team at SVX, Jessica as well, have done outstanding jobs on data analysis, preparation of survey materials, writing, and all of the heavy lifting related to the analysis of many spreadsheets and Excel cells. I was able to play a reviewer role myself. We also had an intern, Sahil, who did an outstanding job of the early aggregation of data and preparation of the survey. And we had a wonderful reviewer and partner in Dr. Basma Majerbi from University of Victoria Impact Investing Hub and Center that was key to this particular project as well. Then also want to make sure we provide a bit of background on kind of the motivation for this, the catalyst for it, and a bit related to the methodology and goals of what we were seeking to be able to achieve. So on the background, I think we're familiar with it, but want to make sure we emphasize. I think it's important, whether we're talking about the most recent meeting at the White House or the pressure of tariffs and economic transition alongside all the other polycrisis we're facing. But more than ever, investment capital needs to be mobilized alongside good policy, alongside community action to be able to tackle our most pressing social, economic, environmental challenges. And impact investing has a path and potential to drive a significant amount of progress, but there's a lack of data. It makes it difficult to measure the sector's growth, its effectiveness, and its challenges. And that limits the expansion of the market, particularly for new entrants, particularly asset owners and asset managers who need that information, need that data and evidence in order to participate in a confident and capable way. And how many times have we heard the question? Those that are curious and those that are critical, and all those in between, what is the performance of these products across the market? We have very limited information. And so we launched the Impact Index to be able to partly answer that question and address this challenge. It builds on 2 decades of effort. And it provides and connects asset owners and asset managers with the static product information. But it's starting to provide some insights on ongoing performance. So building on this foundation, we also conducted a survey, gathering data directly from issuers on their performance. And it culminated in this first of its kind impact investing market performance report. And in terms of what we wanted to be able to achieve or do, let's talk a bit about the goals. And so we want to create a comprehensive market profile of assets, themes, geography, and structures, looking at a product view, so a bottom-up view of the market. Want to take a look at the current and past performance, and also a window into what's the target impact and financial performance for the sectors. This idea is designed over a long period of time. This is going to require a long-term commitment and a long-term time frame to establish benchmarks and benchmarking so we can see greater adoption, greater sector transparency, help with improvements to decision making, provide actionable insights, and really give that data resource for investors, fund managers, policymakers, and ecosystem builders. So all of us that are seeking to be able to advance and build the marketplace. And so then how did we do it? What was the methods that we approached for this particular report? So we have a set of product criteria, and that's on the Impact Index, and we can talk more about that. Happy to dive deeply into it. But it looks at impact investing products primarily on the private side. There is a number of public products as well that have an impact focus, alignment with impact frameworks. they're Canadian domiciled, available to Canadian investors. So meeting certain qualifications and standards. Then on a data collection basis, we've got that source of information from the impact index, about 263 products. We're able to survey some of those folks in order to gather additional, more detailed information on their current performance. And then we're also able to check that based on investor information or data directly from impact investors in order to provide a bit of validation in terms of whether the self-reported data is reasonable and accurate. And then on an analysis basis, we aggregated, cleaned, and then reviewed that information internally as well as had external reviewers as well. Now, there are some limitations to this. And first is sample sizing and composition. So the data set and response rates, particularly from Quebec and Atlantic Canada, can be limited. And that is likely underrepresenting these particular markets. And then there's some self-reporting bias as well. So we had survey data directly from issuers. And so that does present potential for some bias, but we did seek to mitigate that by getting information directly from investors as well as product administrators as well. So we have that viability or validation check. So hopefully that gives you just a bit of a sense, again, as some of the goals, a bit of the background and context of what we're seeking to be able to achieve. And as said, absolutely welcome feedback, both on the report as well as the process. And we see this again as a sector effort. So keen to get your contributions and advice as we seek to do this on an ongoing basis. And with that, I'll pass to my colleague Sharu, who will run us through the key findings.
Thanks, Adam. Hi, everyone. Good afternoon. It's great to see some familiar names in the crowd. I'll start off with running through the key findings, and then I'll jump into some of the other key sections and provide some commentary there. So moving on to the key findings, let's start with the big picture, and that's that impact investing is no longer niche. It's entering the mainstream. Right now, we're tracking over $15 billion in assets under management, and that's a significant pool of capital, but we know that it's not comprehensive. Based on what we have in the database, we have a very strict criteria of products and a very strict definition, but we know that there's more products that are impact aligned that we're not tracking. So you can think of this 15 billion as a floor and not a ceiling. Then it's not just about the size, but it's also about the momentum. So we're seeing the impact investing space rapidly grow. Over the last 5 years, we're seeing a compounded annual growth rate of about 11%, and this trend is expected to continue. And that shows a real confidence in the market. Fund managers seeing opportunities to raise and deploy capital, and investors are increasingly matching that confidence by committing capital and validating those products. The next two findings are around returns. I think the key finding here is that impact and returns are not in conflict with each other. We're seeing that 64% of returns are at or above market rate of returns, and we're seeing a concentration of returns around the 2 to 8% range. So we no longer have to see impact from a concessionary lens. There are products that are offering concessionary returns, but that's a strategic choice rather than a limitation. Moving on to the next slide. Looking at where capital is flowing, the sectoral landscape is slowly broadening out, but it's still pretty concentrated, especially in climate, housing and infrastructure, as well as agriculture. These are things that sort of reflect the national priorities and are supported by federal policies and funding. But we're also seeing the rise of multi-sector products, recognizing that, to solve these problems, you require a systems level product that targets multiple problems at once. The last 2 points are around impact measurement and management, and I think this is where there's some real work to be done in the sector. Right now, impact is being tracked, at least those are the products that we have included in the database. But there's a real fragmentation in sort of the methodologies and frameworks being used, and there's lack of a unified taxonomy. So that makes it really difficult to compare on an apples to apples basis some of the products, and that's really important for institutional investors looking to make significant investments. So until that is fixed, we're going to see some drag in institutional uptake. Moving on to the next section, I'll jump into the product overview and start with the assets under management. If you move to the next slide. Yeah, I'm not going to repeat the big number that you're seeing on the screen, but I think it's important to provide some context around this. I think the first one is that this figure aligns with some of the other past research and market sizing activities that have been done, particularly by the Responsible Investment Association in 2019. They pegged the market around 14 billion back then. So we've added about another billion over the last 6 years. And I think that is important because it's important not to rely on one data point. So having multiple data points helps us to kind of triangulate the actual market size. The other point is around the boundary of this 15 billion, what's included and what's not included. Right now, we're looking at strictly private structured impact investment products. And we also have a very small sample of funds that are investing in impact-oriented public equities and fixed income, but there's a lot more out there. So we're looking to add more public funds that are investing in public equities and public fixed income, co-op assets, and then as well as co-op assets, as well as some governmental and quasi-governmental assets as well. So there's a lot of significant capital on the sidelines beyond our product definition. So once we include that, it'll be significantly a lot more than 15 billion. So we can think of this as a conservative estimate for now. And we're slowly working on expanding the product definition. We need to be careful. We don't want to do it too quickly because it might dilute the impact narrative. So as we do this research further and put out more reports, we'll hope to include more and more of those assets in a thoughtful manner. Moving on to the next slide. This is around growth. We're seeing three distinctive growth phases. I'll focus on the last phase, post-COVID. We're seeing a compounded annual growth rate of around 11%. And we expect this trend to continue. We ended the data collection for this in September of last year. And since then, we've added a lot more products to our database as well. And just based on the work that we're doing here at SPX, we have visibility into a pretty robust pipeline of products and investment vehicles that are under development that will be hitting the market soon. So we expect this trend to continue into the near future. On to the next slide. Just looking at the shape of the market in terms of product type, we can look at it in two ways. One in terms of the product count and one in terms of the assets under management. Based on the product count, we're seeing a lot of fixed income products, particularly bonds, promissory notes, and loan products dominate more than half. These tend to be smaller in scale. Their raise sizes tend to be smaller. They're more place-based and community-focused. But when we look at it from assets under management, private equity funds and venture capital funds dominate. They make up 20% in terms of product count, but about 50% in terms of assets under management. And again, that's expected given that those funds have significantly higher target raise sizes and are looking to pull capital for more complex solutions. I think overall what this is saying is that it's a pretty diverse market and there are opportunities available for investors to construct a pretty robust portfolio. On to the next slide. Looking at the terms of investment, we're seeing a market that is oriented towards long-term capital. Around 70% of the investments have a term of 5 years or longer, and 5 years being the more dominant one. I think that is understandable given that there are a lot of fixed income products in our database, and 5 years tends to be a pretty common bond series term as well. I think there's a gap in the market for short-term products as well, for investors that have liquidity requirements and are looking to dip their toes into impact investing. Having short-term products, I think, would be good as well. So that's a gap in the market. On to the next slide. In terms of headquarters, I'm not going to spend too much time here. I think this is no surprise. I think we're seeing a concentration of products in Ontario and BC, where there's a lot of infrastructure and support. I think we're starting to see a lot more interesting products come out across Canada, but there needs to be more of a systemic push to broaden this out. Moving on to the financial performance. If we jump to the next slide. Yeah. And before I go into the returns, I'll spend just a couple of minutes talking about the methodology here. I think this is a section that gets a lot of interest and people perk up, and I think it's important to run through how we've calculated the returns and also just acknowledging some of the limitations as well. So, as Adam mentioned earlier, this is self-reported data for fixed income returns. We're looking at the annualized interest rates, and then for the PE and VC funds, we're looking at net IRR. It's a mix between realized and unrealized returns. Uh, and then for, when we're defining what's above, at, or below market, we provided some guidelines for benchmarks, for fixed income products, asking them to compare it against bond yields, and then for PE, looking at the returns against the TSX. Uh, yeah, and because it's self-reported data, we wanted to try and add another layer of validation. So we asked for investors to share what's in their portfolio as well. And we did a cross-validation there just to make sure that we're not just relying solely on issuer-provided information. Yeah, and there's also been a lot of hunger for granular information. We've had people ask us about what are the drawdowns, Sharpe ratios, and things like that. And unfortunately, we don't have that level of granularity at the moment, but that's something that we hope to do in the near future as we get more and more information. So, sometimes you have to walk before you can run, and this is us taking our first tentative steps in that direction. So with all that out of the way, looking at the return ranges here, we're seeing 64% of products that are providing at or above market rate of returns. And that's a pretty surprising finding for us going into this report. We didn't expect it to be that high. And then there are 36% that are below market rate of returns. And that's not a limitation, but it's more of a strategic choice. There are some products that are looking for concessionary capital as part of their capital stack. On to the next slide, which is going into a little bit of detail by product type. For fixed income products like bonds and debentures and loan funds, not surprising to see that below market rate of returns dominate here. And for private equity and VC funds, we're seeing at or above market rate of returns. And then on to the next slide, just around the return composition, we break it down by closed and open products. But I think the big takeaway here is that the returns are clustering around the 2 to 8% range. So yeah, there's a range of opportunities that are available for investors to create a pretty diversified portfolio that hits their target returns. So I'll stop there and I'll hand it over to Jessica for the next section.
Perfect. Thanks, Sharu. So I'm going to jump straight into going over the different sectors and our sector analysis here. Go on to next slide. So I'm sure that some of the top sectors are no surprise to folks, but it's great to get granular data on the breakdown across the sectors. Again, this data is based off the count of products, not AUM. So about 80% of the products span across multiple sectors, as you can see in the graph in the bottom left corner, which is great to see that investors are prioritizing products that offer broader impact. We know that there's a heavy focus on climate products, and I'm sure we all suspected that even without this data here, but we can put a number to that. About a quarter of sector combinations are focused on climate and energy. This also indicates that there may be opportunity to expand more social impact focused products. The sector combinations we listed are just the duo combinations, but it's also interesting to see that more than 44% of products focus on more than just two sectors. This gives us lots of opportunity to explore more combinations in future reports. So on to the next slide. So we have provided a few sector snapshots in the report. I'm not going to go over all of them, but to give you some insight into our data for the agricultural sector products, based on a sample size of 14 products, there is a large portion of private equity products for this sector compared to other sectors and over 90% of products are targeting or have achieved at market or above return. So strong financial performance here. There's also a significant portion of agriculture products offering longer term, 10-year terms and so on, compared to, say, example, real estate products, which are shorter and offers more fixed income products here. Next slide, please. Perfect. And of course, as an impact investing report, we're very excited to share a few data on our impact measurement and performance in the market. Just a quick reminder that survey respondents were limited to select up to 3 SDGs and impact metrics here. So we presented the data on SDGs both in clusters and individually. With the clusters, you can see with the exception of the 4th cluster, there's a fairly equal distribution across economic, social, and environmental clusters. Next slide, please. Again, with the individual SDGs laid out, the top SDGs aren't too surprising. Based off the data we previously presented on the sectors, they align quite nicely with Canada's environmental priorities. If we do compare this to GINN's like global investor report, though, there are a few differences in the top 3 SDGs in terms of reflecting on how investors globally are allocating capital amongst SDGs. It seems globally investors are focusing more on health and decent work, but climate change remains as a top 3 priority. However, there is significantly less focus on conservation, which could be an impact to environmental goals, and prioritization on equity remains to be a lower focus compared to climate, which is also reflected globally. Next slide, please. Perfect. We're also excited to share some interesting data on impact frameworks, which is based only on our survey respondents here. Only 22% responded that they use no frameworks, so it's fairly promising that over 3/4 are using frameworks in this case. The data suggests that there is a lack of standardization on impact measurement across the system, which aligns with what we see globally, with a significant amount of internally developed frameworks. This comes with both pros and cons, as this gives more flexibility to address stakeholder demands, but it is a challenge for reporting and comparing products and data across the system. Along with this, we found that many issuers use multiple frameworks, with SDGs and internally developed frameworks being the most popular. What's significant is that 61% of respondents use frameworks using more than one framework. We've given, next slide, please. Not going to focus too much in this area, but along with this, we've given some examples of metrics reported by the respondents, but overall, many of them track measurable outcomes, while many others mainly focus on just the outputs. So there's lots of improvement for room in this area, and so on. Just ending off the impact section, we wanted to focus on some equity areas. Not surprisingly, racial and gender equity contribute to the most focus in terms of equity areas, while LGBTQ+, Indigenous, and disability inclusion falls short in comparison. While 29% don't explicitly have diversity mandates, there has been, significant political turmoil around DEI recently, which have caused some shifts between those who openly versus privately integrate DEI into their mandates and so on. So just saying again, this data set doesn't fully capture equity-focused mandates, those aimed at structural change, wealth redistribution, and economic empowerment. And this is an area that we hope to improve in future reports. There's more data on impact measurement in the report, so please do take time to read through it yourself, and I'll pass it back to Adam to bring us to the last stretch of this.
Wonderful. As well. I think we wanted to make sure we then covered kind of sector strategies, or what does this tell us, or what direction does the data provide for where we can go next. And so let's go to the next slide and talk about the so what. What are some ways we can get to some systems level strategies to scale impact investing? And really, we see this as a shared responsibility. So issuers, asset owners, and managers, as well as policymakers, how can we together sustain and scale the impact investing market? So there's a number of different ways we think we can do that. One is we really need to continue to improve tracking financial and impact performance at a systems as well as institution level. So we need to be able to provide that information, aggregate that information, and really ensure we can develop those benchmarks for performance, which we think is going to get us to greater scale. Second is, how can we pursue greater standardization? It is a long effort. We think about, the GAAP standards and accounting standards took a long time to be able to get that to a commonly understood and adopted framework. But I think this is really important for us to pursue. And there's lots of folks that are doing this in a really great way. but really need to make sure that we are pursuing that standardization of frameworks and metrics so we can reduce complexity and make sure we can compare things like the common approach to impact management and as well as the work of the wholesalers are really making efforts to drive that. And I think greater uptake of that kind of framework is going to get us to greater transparency, investor confidence, and ultimately greater pools of capital. Then what else? A few other ways that we can drive change, we think, in the market. I think there's a need to be able to support the maintenance of existing, as well as support the development of new and innovative impact investing products. There's lots of ways we can do that. There's incentives, there's funding, generally a supportive policy environment, and requires balancing approaches. So we need to make sure that larger funds are well positioned to attract institutional capital and deploy it at scale. Smaller funds also require resources and support. And so we need to blend that strategy where we can scale those larger ones and support those smaller entities, and through a combination of things like tax incentives, targeted assistance, and operating infrastructure and technical support to allow for that startup and scale. And this is reflected within Jessica's remarks. We really need to continue to advance greater adoption of policies, procedures, and metrics that focus on racial and gender equity. We know that it's a challenging and difficult topic in the public at the moment, but it is valuable for both a moral and economic imperative. And so the lack of these kinds of mandates presents a missed opportunity. So there's great potential to invest in and finance a range of different Indigenous communities, LGBTQ plus individuals, women, persons with disabilities, racialized communities, and beyond. They're going to drive positive impact as well as solid financial return. The data really proves that. And then how can we also scale and help folks develop balanced impact investing portfolios that include a range of different products? So how do we get into the water supply or the shelves of larger institutional investors or asset managers? And so if they can provide the ability to aggregate the different range of products that are available, that's going to allow us either to create customized portfolios or off-the-shelf opportunities. And we've done a bit of analysis on some folks that deliver those balanced portfolios, but we believe there's an opportunity to do more. And I will say that a lot of these recommendations that we're outlining here or directions from the data hopefully align with other reports that have come out in the market. There was a great one done by the Canadian Impact Investing Working Group, a number of other recommendations that are echoed by folks like Catalyst Community Capital Initiative. So hopefully this is broadly supportive of what are long-term directions that the sector has held and driven. So then for us, just on the next slide, and then we'll get to some questions and conversations. Let's talk about what's next. So a few things that we want to do with this particular research direction and report. So one is an annual refresh. We want to do year-over-year data and trend tracking to provide benchmarking for decision makers. So think of this almost as a bit of a year one. We've got to get that long time horizon graph on performance to be able to get it on to kind of institutional shelves. Want to make sure we have a wider product lens, so broadening it to include more funds that are in the public markets that would have balanced products. Want to include bonds, deposit products from credit unions and beyond. Oh, that's going to grow the asset mix. Then get some investor intel. We did an investor survey a number of years ago. We want to be able to come back to that to be able to map their flows and preferences. Then more deep dives into thematics that are interesting for investors in the ecosystem. Community finance, housing, funding for small and medium-sized businesses, local clean energy, biodiversity, and beyond. And then we want to create a bigger map. Again, this is a starting point. There's a need to have deeper coverage into Quebec, which is a robust and vibrant ecosystem, the prairies, Atlantic Canada, Northern Canada, plus a wider reach across the Americas as well. We've got a number of partners there. Allows us to be able to compare, but also identify opportunities where Canadians can otherwise invest or place their impact capital. that's a bit about what's next for this particular research report and direction for SVX. So it gives you a bit of a summary. I know we've got some questions in the chat. I want to make sure we get to them right away. And I'm going to kick things off and maybe identify. You can put them in the chat if you want to raise your hand. That's fine too. But Katie had a question first. Maybe I'll go to you if you'd like to be able to open up your mic and ask your question, offer a bit of context, and we'll see how that rolls and go through the questions in order. So Katie, if you're comfortable, feel free to come off mute and ask the question directly.
Sure. Thanks, Adam. Thanks, everyone. This is a great presentation. Yeah, I'm just curious about whether the assets under management figures reflect Canadian investors investing into the Canadian impact investing market or Canadians investing in emerging markets I'm a member, a very active member of the Canada Forum for Impact Investing and Development, CAFID, who many of you will know of or are members of, and we reflect members of both those markets. And so I'm actually more familiar with Canadian investors who are investing into emerging markets, but I know that the Canadian domestic impact investing market is growing as well. So I'm just wanting to understand those AUM figures.
Well, thanks for your question. Maybe I'll pass to Sharu to cover that one.
Yeah, great question. So right now, what we're tracking is Canadian products that are domiciled in Canada, and we don't have an exact breakdown, but a vast majority of that AUM is deployed within Canada. But we do have a very small contingent of products that are investing in emerging markets. So think of, Deacon Impact, Sarona, but a vast majority of that 15 billion, I want to guess maybe around 80%, I would say, are deployed within Canada.
Great.
And I think the other side of the coin would be looking at the investor data. Just as you said, part of our investor research would be to look at where then investors deploying, because this is a bottom-up product analysis, but there's going to be Canadian investors that are placing their capital in other domiciled products with managers outside the country. So be great to imagine what that looks like, and maybe there's partnership opportunities with what you're doing, the great work at CAFID.
Yeah, I was just going to say, because CAFID does a state of the sector report as well. And we're actually planning our next one, so there could be ways to collaborate.
Amazing. That's great. Thanks for your question. Let's go to Johan. You got a question about the balance of the portfolio products. Maybe you want to dive into that question a little bit.
Sure. Actually, the bigger, larger question is as you know, there's this emerging trend going from the old 60-40 debt to equity to debt to 50-30-20, with 20% being to alternatives. So interesting if, in the bigger picture, and then also matches with the allocations between retail versus institutional. So I guess the easy one would be, is your current data set, if you will, heavily institutional versus retail? And also, where is that trend, where's the traction across the country in terms of growth rate among retail investors? And again, within retail, obviously there's self-directed, advised, and delegated. So lots of questions that I'm sure this is your second year of the report, but you guys have done a great job. So interested in your reflections.
Great. Many thanks for your question. Maybe happy to go to Sharu and also happy to reflect on that question as well.
Yeah, I mean, well, we don't have the exact breakdown between institutional and retail as well. We're just tracking AUM at a high level. But again, if I had to take a guess, vast majority would be institutional capital and a very small percentage in retail. In terms of the asset allocation trends, I don't know, Adam, I defer to you on this one.
For sure. I mean, our sense of things is that folks are, for the investors we speak to, and again, that'll be part of the report we'll look to do through a partnership with Impact United. There is a definite movement towards alternatives, particularly in a more volatile market environment, as well as if you think about the impact and financial performance, which seems to be proving itself to be viable. And again, we want to make sure this is about balanced returns, not outsized returns. This isn't impact investing is one that's going to hit 10 times home runs and allow you to buy an island in the Pacific or the Caribbean. This is about making sure we show that it is a viable investment strategy. But I think if you look at the privates, which represents the vast majority of impact investments, again, it's reflective of the opportunities that are available for investors to be able to place their capital in this particular way, moving from the, as you said, traditional 60-40 split, which has very little to no alternatives, to one where you can create a sleeve or a part of the capital you have invested in alternatives, and the impact investments would represent a really interesting way to be able to fill that part of the portfolio. And we've had a number of asset managers that are pursuing those strategies directly or are seeking to be able to create those strategies, either custom portfolios with seg accounts or brand new products, or otherwise, as seen from our data, there's about $1 billion in this segment of folks that have created custom products. And happy to talk about that more, but that's a great question.
Yeah,
Thank
and
you.
just to build on what Adam said, I think on the private side, from an impact narrative perspective, there's a stronger narrative for a private side. Like it's easier to like really meet what your impact narrative or what your impact targets are through private impact investments rather than on the public side where it's the definition is a bit broad as well. So I think that's one advantage of the private investments as well.
Excellent. Well, thanks so much for the question and a great conversation, a long one as well, long term. Let's go to Matthias with your question. If you're comfortable again, coming in, raising your hand and joining the chat.
Yeah, thanks, Adam, and congrats to the team. I think this is an awesome report. Love to see it, and looking forward to many more, building on the data and insights. So thank you for putting this together, all your work. I had a question on the breakdown of the underlying data set by private versus public, and I think there was sort of an explicit acknowledgement that there's probably an underestimate of the public impact investing products in the market. And so I'm wondering just what that breakdown was, and if you've done any thinking about like estimating the scale of that underestimation to try to understand, is this a 30 billion market that we estimate, but we're actually just not capturing it, or did we get pretty close? Yeah, curious about reflections there. So that's one. I might just sneak in a second question or comment while I have the floor, and that is just on the benchmarking. And I'm curious about the rationale for characterizing market rate, for example, with PE and VC funds. I believe if I understood the report correctly, you're benchmarking against like S&P 500 or ACWI or some other public benchmark. And I'd be curious why you didn't request that people benchmark against a relevant private market, sort of like median perhaps, just given the potential big differences there. But thank you again.
Yeah, great questions. And so maybe first let's talk about the breakdown. But sure, do you want to talk about breakdown? I'm happy to talk about the estimate, like what we would think the scale of the rest of the market is.
Yeah, in terms of the breakdown, so we're tracking 15 billion in total. Out of that, 14 billion is explicitly private, and then we have we just sampled 5 funds that are investing in public equities and fixed income, and they account for about 1 billion right now. So we know that there's a lot more out there, and I'd love to get your sense on the total market size and estimate, but that's the current breakdown.
For sure. And we were careful about the qualification of the public and fixed income product. We went through a pretty rigorous process, and we created a kind of a managed product category or collection on an SVX. Because there is a significant debate of what's in and what's out kind of in the public side of things. And so we need to spend a lot of time figuring that. But the sense is, if you look at the RIA report, which again is excellent, is primarily, not exclusively, but primarily weighted in term deposits, credit unions, and more public product. And so the guess, and this is an estimate, not a thumb in the air, but an estimate would be it's probably double the size. If you think about what is available kind of on the other side of the public and fixed income shelf. We just, I think, again, with partners and input, need to figure out what fits in that bucket and what doesn't. Because I mean, do you include green and social bonds like the City of Toronto's social and green debentures? Are they in or are they out? And then obviously which term deposits from credit unions are in or out and otherwise. There's lots of folks that are putting impact on their ETF, but it's a brand exercise. On the benchmark side of things, maybe again, Shar, do you want to talk about what benchmarks again we use just for clarity's sake and how folks were categorizing that?
Yeah, so again, it's not the perfect comparable. We're trying to find what's the best proxy. So for fixed income, we looked at comparable bond yields, and then for on the private side, looking at the TSX returns. I think we landed on this just because of the availability of information. Sometimes on the private benchmarks, based on our scan, we felt that it was difficult to find the right median benchmarks for them to benchmark against. So we thought that we'd use this. But yeah, maybe going forward, we would need something that's a little bit more robust and nuanced to take into account the private market side of things.
Yeah, and I think a lot of it is self-reported on where folks see themselves in comparison to below, at, or beyond market. So how they're positioning themselves. They're given a bit of guidance. The other is, I mean, even in Canada, the private market benchmarks are limited to almost a non-existent. There's US benchmarks, but we don't have a lot of data on private market performance. It's available, but we could say it is a bit of an underestimate. And so another limitation. But as we grow and see more products and can see established benchmarks, I think we'd want to add that to the mix. But great question.
Thank you.
Wonderful. Thanks, Matthias. And so I don't know the individual that asked the question for data on returns about actual or historic performance and the pre or post fees. So Fremon01, if you're comfortable joining the conversation, you're most welcome to, or otherwise I can just read it through. So let me know if you want to join us and have a chat. We always allow 7 seconds of Zoom silence in order to be able to manage. And so let's just go to that question. So maybe again, we'll pass to Shar to talk about the division of actual as well as projected performance. And maybe I'll just say I can answer the second one, which is these are post fees, right? So there's these are the post fee returns. But maybe you want to talk about the actual and historic performance and future performance.
Yeah, it's mixed. So we try to break it down as best as possible, but recognizing that a lot of especially on the PE side, it's model derived target returns. Just keeping in mind the fund life and that the funds are still open and still deploying capital. We could do a deeper, more granular analysis, just looking at when the funds were launched and then looking at the fund life to see if they're closed, and then looking at if the return data is there, we can categorize them as realized returns. We haven't done that yet, but yeah, right now in the data set, it's mixed. Yeah.
But also it is disaggregated, so we can see which ones are kind of target versus actuals, and so hopefully that gives us a good way to see where the market is and is positioned. Let's go then to Ishara. Ishara, if you want to join the conversation, you're welcome to. Happy to have you speak to your own individual questions.
Yeah, sure. Thanks very much for this very, very insightful report. So my questions were more around the impact measurement and management side. And there's a few of them there, so I'll try and quickly talk to all of them. So the first is just when talking about internally developed frameworks, do those draw on existing sort of global frameworks like the SDGs, et cetera, Impact Frontiers, 5 Dimensions, and are then sort of customized to the investor, or is it entirely internally developed? Yeah. And then the other 2 questions was around, is there any focus on impact scoring tools to help with comparability, decision making around which investments to pursue, and maybe even taking that a step further to look at the impact rate of return, trying to quantify and monetize potential impact at a screening or DD stage, and then obviously tracking that over the course of the investment.
Wonderful. Many thanks for your questions. These are super important and excellent ones. Maybe I'll pass to Jessica if you want to talk a bit about these particular questions.
Yeah, for sure. I'll take a stab at these, and Shar, feel free to jump in afterwards as well. With how the survey was kind of structured, we can't necessarily say 100% that the internally developed frameworks all like draw on SDGs, but from the data and the fact that it is like the highest portion combination in terms of internally developed and framework and SDGs, about 20% use that combination. There is the assumption that yes, like quite a lot of them do use a global SDG framework there. It is probably like the easiest framework to also draw in for them as well. Not in this report or what we've tracked, but from our wider work with a lot of these issuers and respondents, perhaps some community-based issuers might not necessarily use anything other than SDGs for global frameworks, but products that are perhaps investing capital outside of Canada will likely be using global frameworks, given they're likely attracting more global investors and so on. On the focus on impact scoring tools, it is something that we'll probably take in consideration for our next report. It's just, again, this is our first iteration of this report. And it's definitely, I think it's mentioned in the report that this is something we want to look at for EDI in that area in terms of how it's integrated into a lot of issuers in terms of their measurement and so on. And the focus on calculating the impact rate of return, I think that's quite difficult and perhaps something for farther discussion with the team, but I think perhaps that's farther down the road there. Shari, feel free to add anything in there.
No, that's pretty comprehensive. I mean, from what we're seeing, these internally developed frameworks, like framework might be overselling it. It's very weak, and they're just kind of tracking metrics. So yeah, it is quite very, like, some of these products are like first-time fund managers and stuff. They're really struggling to like align with it. So it's just tracking metrics at the moment. It's very basic. And then around the other questions, I think those are great things for us to do when we do the investor survey and look at it from the other perspective and how they're thinking about impact and how they're making investment decisions.
Great. Perfect. Thank you so much.
Thanks, Ashar. And some of our recommendations speak to that as well, around what can we do to encourage increased capacity and capability on adoption of standards, frameworks, principles, again, like the common approach, impact frontiers, and beyond. So really appreciate your question. I think it is a great discussion for us to continue to have. Let's go to Elena. You're most welcome to join the conversation and ask your question.
Hello, everyone. I think you kind of like answered my question about the sort of like tracking capital that was deployed, not just raised. So I want to take this opportunity to actually ask another question on the emerging funds. How did you define which funds were included in the index? So like at what point do you draw the line between sort of like emerging and pre-launch funds? And would you have, or like for future iterations, would you track, any patterns, any trends to in the emerging funds space?
Well, super great questions. Also, maybe just identify the one you'd raise in the chat as well, and I'll pass to Shar on the emerging funds question. But I think there's more research opportunity related to how much capital is deployed as well as returned. And I think from a sector perspective, someone helping to answer that question, I think, is helpful, and perhaps it's integrated into our future research. But a great one. But Shari, do you want to talk about kind of criteria for qualification and how we would understand an emerging fund?
Yeah, that's a good question. So right now, the criteria is funds that are domiciled in Canada that have a minimum raise size of 2 million, that are tracking impact metrics. For emerging and new funds, we don't have a specific criteria. Adam, correct me if I'm wrong. I'm blanking on the exact criteria at the moment, but yeah, I don't think we draw a very clear definition just in terms of when the fund was launched and how long they've been active. I think that's what we look for at the moment, if I'm not mistaken.
Yeah, that's right. I mean, we are trying to work on in order to make sure there's the right balance where we can share products in development. I think a lot of folks are developing interesting and innovative impact investing products. I want to provide a showcase for that. Important for folks to be able to see, test, and understand that, but also kind of managing the securities regulations around, what to, present and share. I think we'll probably have more information on that. Maybe a collection of emerging products might be something we could also highlight or put on the impact index in the future. That's a great question.
Yeah, I think we also differentiate between first-time fund managers and experienced fund managers. So we track funds itself. So there are certain follow-on funds, Fund 1, Fund 2. So they're classified as kind of experienced fund managers, and those who are launching new funds for the first time would be considered as new fund managers.
Wonderful. Well, it was a great set of questions. Thank you, Elena, for yours and for all the others for asking your questions and engaging in conversation with us today. Really, again, appreciate all the effort and work of the partners, the authors. You had a chance to be able to chat with a couple of them today, and for you for making time to join us. If you have questions or feedback, please feel free to email us. Obviously, we're also most interested and invite you to provide support to the next iteration of the report, both from a data provider perspective, advice and insight. We want to make this something that is better and useful for the market. With that, I think we'll end it today and hope you have a wonderful rest of your morning or afternoon or evening or whatever time it is for you. And we'll look forward to the next conversation. So thank you.